I thought the trade I'm going to share with you in this video was the safest wheel setup I'd ever done. The chart looked good, I had a solid company, and then premium was nice and fat. But then the stock price dropped. The position went against me, my capital was going to be tied up for weeks or maybe even months into the future. My yield collapsed because I couldn't adjust it, so basically I was just stuck. That's when I realized the traditional wheel strategy, well, it's got a problem that no one really talks about. It works great until it doesn't. So I went to work trying to figure out how to tweak the wheel strategy. And what came out of that experience has completely changed the way I'll trade the wheel strategy from now on. Everyone talks about the wheel strategy like it's the greatest option strategy ever. Sell cash secure put options. If it gets assigned, you turn it to a covered call, let that be called away, then you just kind of rinse and repeat the whole thing over and over again. And that all sounds great in theory, but there's a catch. When it goes against you and that cash secure put option is assigned, it can tie up a lot of capital. If you sold one put option contract at the $8 strike price, you're tying up $8,000 for as long as it takes for that position to go back in your favor. And as a result, your yield drops. You might only collect like $100 in premium for that $8,000 you have tied up. And once you're assigned, well, your flexibility to adjust that put option, it can really handicap you. It can be very difficult to pivot or adjust the situation. You're just tied into owning 100 shares of this stock that has now gone against you. Here you see the chart of the trade I'm going to talk to you about. Now on the far right is the day I entered this trade or I sold that cash secure put option. It was May 22nd. Notice what the chart looked like. This company here is CNC. So overall I have been in a decline on this daily chart. It not only broke through that downward sloping trend line, but then pushed through this recent resistance here from these highs back in this wave. See, it pushed through it right in here on a nice big strong green candle. So it had now made a new higher high from the previous wave. Everything looked great. It looked like it was going to be an easy win for me. But then this happened. Notice how the stock had a very sharp decline. It started out so promising, but in the end, I ended up being assigned. So now I've slid the chart all the way over to the day I was assigned. I was assigned the stock on October 18th. And notice what's starting out as a really nice promising trade back up in here, it turned into a total disaster. What made it worse is that if I did a cover call at the strike price where I was assigned the stock at, I get pennies on the dollar for it. So I basically get zero return. So how can I fix that problem? How can I trade the optional strategy and have a lot less money tied up in the trade? Do I try and roll it out in time a little bit longer to see if it'll go against me? Do I wait and pray? Or should I just close it out and take the loss? Let me talk you through the option trade I did that changed everything. It changed my whole perspective of how to trade the optional strategy when positions go against you. We're going to have the same setup, the same stock. We're going to experience the same drop in price. But instead of doing a covered call, I did something different. I did something that required a lot less capital than if I had done a simple covered call. In fact, it cost me about 60% less capital than if I had done a covered call. Here you see the details of the trade I did. Up top, you see a snapshot of my actual trades that I did in CNC when this happened. Remember, we've been assigned 200 shares, and just so you know, I did 2 put option contracts in CNC, and both those put option contracts were signed. So step 1 was to get rid of those shares that I was assigned. I did that by selling those 200 shares of CNC. I got $60.80 per share. Ouch, not good. But by using options, I switched up the way I traded the option wheel strategy. And here's how I did that using options. Once I liquidated those 200 shares that had been assigned the previous night, I bought a call option. And I won't go into the extreme details of the situation because I probably made it more complicated than it needed to be, but simply put, I sold those shares and I bought what's known as a leap call option. I bought the $50 strike price call option. If I scroll back up here, you see that $50 call option, it cost me $16.47 per share. So although I had been assigned the stock at $72.50 per share, my new option wheel trade only cost me $16.47 per share. That means I saved $56 per share. In this scenario, it would have cost me $56 more to do this optional strategy. But because I switched those shares out for a leaps call option, it saved me over 77% of that capital I would have been out of pocket if I just continued to own the shares. And here you see my actual position in CNC. This January 16th of 2026 call option, that's what I used to replace those shares of CNC. And can I still sell my near-term short call option against it? Or as you see here, that's exactly what I've been doing. In fact, the one that expires here in just a couple of days, I sold the $67.50 call option against those shares. And that option is pretty much expiring worthless. So now as you see up top here, we're in a synthetic long stock position, but it's costing me a fraction of what the shares would have cost me. I still get all the same benefits as if I had done a covered call. Now that we own the in the money call option, I can begin to sell short near-term call options against it. We can sell those weekly, bi-monthly, or monthly. And you can even go farther out in time if you want to. Typically, I'll go out about 50 days. But which strike price should you choose? Remember, CNC had gone way against me. As you saw just a minute ago, although I had been assigned the shares at $72.50, I was selling the $67.50 short near-term call option. So you gotta think through what strike price you're going to sell that near short-term call option at. And here's some key points to keep in mind when it comes to making that decision. Now, if the stock is looking weak, you can consider selling those call options in the money. That gives you some more protection if the stock continues to decline. But just keep in mind that if the stock reverses and goes back up, that short near-term call option could go against you pretty fast. The next place to sell it at would be at the money, or right at what the stock is currently trading at. And that's more of a balanced approach, and one I might do if I thought it would trade sideways for quite a while. Or as you saw in my position, even though I was selling that call option below the strike price I had been assigned the stock at, I was still selling it pretty far out of the money. That gives me a lot of room for CNC to come up in price before that short near-term call option is challenged. And this is a question I get asked a lot. Randy, what strike price should I use? What delta strike prices do you sell your covered calls at? Or in this case, your poor man's covered calls at? I don't use delta when I'm selling near-term options, whether it's covered calls, poor man's covered calls, or cash or put options. What I'm primarily looking at when it comes to selling call options, like in this situation, is resistance. Where do I expect the stock to have a hard time pushing through? Well, that's the price I want to sell that short near-term call option at, either right at that resistance or even better, just above it. Here's a quick game plan on what you do if that short near-term call option you sold goes in the money. Because obviously, since you don't own the shares, you don't want to be in jeopardy of that short near-term call option being assigned and shares that you don't own being called away from you. So here's how you handle that scenario. As you're nearing expiration, when you see that most of the extrinsic value of that short near-term call option is gone, at that point you buy that call option back. And you pay for it by selling a new call option at a higher strike price farther out in time. That gives you more time to work the position. Or if you're back at a price where you'd be happy just to exit the overall position, you can sell your deep in the money call option that you bought instead of owning the shares. That will allow you to reset the wheel and start the wheel strategy all back over again by selling a new cash secure put option. And here I want to give you one more idea to kind of juice your return up when positions go against you. And I do this all the time. When a cash secure put option position is going against me, and I've done this strategy I mentioned already in this video where I've turned it into basically a poor man's covered call. But how can we juice this return up even more? Well, in addition to owning a call option that's in the money and selling near-term call options against it that are at the money or out of the money, you could also consider selling additional cash secure put options or bullish put credit spreads once the stock is stabilized. What this does is it mimics having a poor man's strangle or covered combination. You're selling puts, but you're also selling near-term short call options against the call that you own that's in the money. And you don't have to go way out in time. You can buy that in the money call option that expires in a month or two. Just know you'll have to roll it more frequently if you don't buy that longer term call option. By selling a put option and a call option in the same position, it basically doubles the amount of cash you're receiving by selling options. Just make sure you're financially prepared for what might happen if the stock continues to decline in price and that new put option you sold is challenged. Now let's talk to the pros and cons of using this strategy. First, a pro that we've already highlighted, and you've seen it in this video, is that this means that we have a lot less capital tied up in this position. That means if it goes our way, we have a lot higher capital return on our money. As you just saw, you have the ability to scale into positions by selling additional cash secure put options once the underlying stock is stabilized. But what are some negatives about using this type of position? Well, as you saw, there's a lot more moving parts. You have to watch not only the options you're selling, but also the one that you own. As a result, you need to watch the Greeks of your options more closely. You want to watch theta to make sure the time decay and the near-term option you sold is higher than the one that you bought. You also want to watch delta. You want to make sure that the short near-term call option you sold, that delta is lower than the call option that you bought. So overall, it's just not as simple as if you just owned the shares and did a cover call. As you saw, you can have a lot less capital tied up in a position that went against you. So let's talk to this real life example so you can see how it goes. First, you're selling cash secure put options against a position like I was with CNC. Then those put options are assigned to you. At that point, you sell those shares and you buy an in-the-money call option. You then sell a near-term call option against that in-the-money call option that you own. Once the position reaches a price where you're happy to get out of it, you sell that longer-term call option that you own that's in the money, as well as close out the short near-term call option that you've been selling. Then you're back to an all-cash position. You can start your new upgraded version of the optimal strategy all over again. And as you see here, you can continually roll that shorter near-term call option out and up or down as you see fit for as long as you like. In fact, last month, as you see here, we rolled our March call option out to April. Now in the next few days, we'll be looking to roll the April option. If this video helped you out, please give me a thumbs up and share it with some of your friends that you know are having a hard time on some of their positions. Hopefully it provides a way for you to improve your positions with a lot less capital. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. If you'd like to see one skill that every option wheel trader must know, check out the video at the link above and the description below entitled, "You must learn this skill if you want to trade the option wheel strategy." Until next time, happy investing, and we'll see you again soon.